The biggest part of that announcement was the verbiage that came out saying that they are going to continue cutting rates as long as the economic data supports it, which I think it will, because we are in a slowing economy. What's up, everybody? Scott Nascenti here with Pritish Raval, back with another episode of Leverage. You know we had to hop back on here with the big announcement, half-point rate cut. We know it's been beaten to death already. Everybody knows that they cut the interest rates, but we want to give some further insights here, dig a little bit deeper into not what just happened in the past, but what we think is going to happen over the next 12 to 24 months, so you can get ahead of the game, save some money on a purchase potentially, or maybe make some money if you're an investor. So obviously, Pritish, we had the announcement there. I personally, the announcement's one thing, a half-point rate cut. We already know it's not going to improve affordability just yet. But what I think the biggest part of that announcement was the verbiage that came out saying that they are going to continue cutting rates as long as the economic data supports it, which I think it will, because we are in a slowing economy. So give us some insight on that and where you think, not where we are, but where we're heading.
Yeah, so I think there's definitely some more big rate cuts coming. I think if I had to make a prediction, not that it matters because I could most likely going to be wrong, but I think there's still potentially another 1.75% in cuts coming, before the end of next year, which is much needed, I think, to actually feel the impact of these cuts. We need some bigger, deeper cuts coming in the near future.
Yeah, the half-point cut was a surprise to some people. Like, it's considered a jumbo cut, relatively. They haven't cut this much half-point. I think other than like very serious situations like the 2008-2009 financial crisis was the last time we saw a big cut this deep. So it is a big deal, and it is telling us something, and it's probably telling us that they were too high for too long. It was too prohibitive for the market. We have to understand, when rates are too high, businesses stop hiring, builders stop building, businesses stop investing, they stop buying, expanding, buying more real estate, et cetera, et cetera. And that's why we're seeing the unemployment data across the country spiking right now, because the rates have been too prohibitive for economic activity. Now, what the Bank of Canada is trying to do is find a neutral rate where it's neither too accommodative, which causes inflation, or too prohibitive, where it's causing deflation, essentially. Because if I understand correctly, if you backed out mortgage interest costs and rent, which is a big part of the CPI basket, we might actually be negative inflation right now, which is basically a recession. So it's very troubling economic data, which is why we got the jumbo cut. Now, here's the thing. We are not at a neutral rate yet. We are still way too prohibitive, which tells us that there are going to be more cuts coming. Now, that's not just us saying it. Tiff Macklem said it. The Bank of Canada said it. We know that the Bank of Canada doesn't like to stoke the market if it's not needed. They don't want to come out too dovishly and really get inflation going. So when they say something like that, you have to take it pretty seriously. So 1.75 cuts, that would bring us down theoretically to...
I got to do the math on that. I think 2.25, right around there.
Yeah, because,
2%.
Yeah, so
we're at 3.75 right now, so bring us to 2%.
So down to 2%, like that. That's a big dip. So if we had that, where would you think that the fixed rates would be? Like, obviously, you're a mortgage specialist, so where do you think the fixed rate would be and the variable rate at that time if we hit a 2% bank rate?
So right now, the bank's prime rates are at 5.95. So obviously we would be cutting it down by another 1.75%. So that's going to bring us to, 4.25 range or 3.25 range. So that would mean that the fixed rate should be around that range as well, right? Historically, variable rates have been lower generally than the fixed rate. This is one of those times where it's not. So I think we need to see some deeper cuts for, at least on the mortgage side or residential mortgage side, so for people to feel relief. The relief is still not there yet. Even with these cuts, the relief is not there.
Yeah, can we explain why that is? Like you said, the relief is not yet there. The affordability has not actually improved despite this rate cut. I know you probably get a lot of calls when you get a cut like this. Hey, can I get approved for more now?
Yeah.
And that's not always not the case at all.
So
really.
So pretty much like the number one thing that happens to me whenever there's a rate cut announcement is my phone just blows up. Everybody's just calling to see, hey, does that mean my mortgage rates went down? Can I afford more? And you might see a lot of information or media out there saying that, affordability is going up, but that's just not the case. And the reason being is because the fixed rates, which is what most of the consumers are going with at the moment, Fixed rates are not impacted whenever the Bank of Canada makes an interest rate announcement.
Great point. That's a totally different market. It's based off the bond market. We're not going to get too much into that, but when the Bank of Canada cuts, it does not impact fixed rates directly. It might indirectly impact them, but let's not get into that. Let's focus on...
well, yeah. So, like, I mean, not even getting into that, but so, like, let's say somebody coming in to buy a house right now, right? Someone wants to buy a property. Do you think they're doing a variable mortgage or a fixed mortgage?
Well, after talking to you, I know they're doing it fixed.
Yeah. So
and explain why that is.
So if you come in, if let's say you want to buy a house, you go to the bank or your mortgage lender. If the variable rate is at 5.95%, and let's just say for our conversation, you're getting 0.5% to 1% discount on that. So if it's at 5.95%, almost a 1% discount means your net rate is 5%, and your stress test is going to be whatever your net rate is plus 2%. So it's 5% plus 2%, which is 7%. Now, if you're looking to qualify for the most amount of money, that means you want to have the lowest rate possible. And right now, the fixed rate is, let's say, around 4%. So if I'm qualifying a client, I would much rather qualify them at a 4% rate so they can afford more on the mortgage versus a 5% rate because the stress test
and
is
that would
lower.
be 4% plus 2%, 6% versus 5% plus 2%, 7%.
Exactly.
Now, what would 1% typically increase an affordability, right? If you're getting that 1%.
I should have my numbers ready. I don't have my numbers ready.
Top ahead, approximate.
Oh man, I couldn't even tell you right now. But you know what? It could be, the difference would be like, let's say if it could be like between 400, someone qualifying for 400,000 to like 450 to 480. It could be significant. Yeah.
And that can be the deal breaker if somebody wants to get in the market. If they can only get approved for 400 versus 450 to 480, the homes available in those two different price ranges might prohibit somebody. Okay, well, I'm only approved for 400. I'm not going to bother because I don't want any of those 400.
Well, that's the challenge right now, right? So everybody wants to qualify for the most amount because they want to buy the best house, right? We rarely find somebody coming in that goes, hey, you know what? I want to do variable because I'm extremely confident that the variable rates are going to go down. Now, that's not a bad strategy, actually. If you can qualify on the variable, you could take a variable mortgage right now, and in the future, you can convert it to a fixed rate with no penalty generally.
Yeah, so the qualifying is the big problem here. And the qualifying is a problem because of the stress test, which is adding 2% on to your mortgage quote, which is very prohibitive. And it could be $100,000 to $150,000, it sounds like, of qualification ability because of that stress test. Now, I think that the stress test is way too burdensome now. It was put in place when rates were ultra low, emergency rates. They put this in because they knew they were going to have to eventually raise them. And now that the emergency rates are gone and we're in a rate declining environment, I think the stress test, maybe don't eliminate it, but maybe it should be 1% or something instead of 2%. We got to get affordability back so that the builders can get back out there. We still need homes built. We still need the economy to get going again. So that's my thoughts. We'll see if they do anything about it. They have put in some other measures, but yeah. So the important things to note here, the affordability, the qualification,
has not really changed.
Has not changed.
So like a lot of people will get out there and say, oh, the rate cut has happened. You should be able to qualify for more. So you really don't unless you're doing a variable product. That's it.
Now, in my experience as a realtor, qualification ability mostly impacts first-time entrants into the market or people in that lower to middle budget range. A lot of people that are already in the market, they have a house to sell, qualifying isn't that big of a deal all the time because you're putting a big chunk of money down because you're selling your house, you're getting $400K in equity, you can put a big chunk down, you can qualify for more money. So it really disproportionately impacts the lower range of the market, the first-time buyers, the new entrants into the labor market that haven't saved a bunch of money or don't already own a home. So, and they're really trying to improve affordability for the first-time buyers and whatnot. So it's a little bit unfortunate, but very valuable information there. And again, I think that the key is here, without sounding like everybody else trying to pump the market, is we know that when interest rates fall, asset prices go up. And we don't want to be waiting for the rate cuts to happen. You obviously have to take a stand here. If you think that we're going to see 1 to 1.75% further rate cuts in the next 12 to 18 months, if that's what you think is going to happen, you probably shouldn't wait for it to happen. You should probably be looking to enter the market now or invest now, whatever your game is.
Well, everybody's waiting, right? That's the other thing. There's a lot of people that are waiting, and if everybody enters the market at the same time, it's going to create a pressure on the prices. And so, I think if you are in a position, if you're even thinking about it, I think now is not a bad time. And if you're waiting for some of those rules to come out, in December, in terms of the amortization and being able to do 30-year amortization as a first-time home buyer, there are a lot of clients that are waiting to do that, right? So you may be competing with those clients as well. So ultimately, you may pay a little bit higher price tag if you end up waiting, right?
Yeah. An interesting strategy right now could be to get something under contract closing in the new year,
right?
If you have that option. But I think in general, we're on the same page here that we are in a downward trending rate environment for the foreseeable future. That's not just based on we just think that's going to happen. The Bank of Canada has stated as much, and from all the economic data, they have no choice. We are heading also into an election year in 2025. You know that they want a strong labor market, a strong housing market. They want the consumer to feel good and that they can go out and spend money. Heading into the election, they're going to do everything they can to make people feel good about the economy.
Definitely.
And that is going to be further rate cuts. But even without the election, they still have no choice, in my opinion. It's either that or risk a huge, massive economic downturn where people are losing their houses and jobs, etc. So we're going to get back to a neutral rate. They're going to, have to figure out what exactly that rate is, but it's much further down from here that we can say for sure.
Do you see an uptick? Whenever there's a rate announcement, do you see a lot of clients starting reaching out to you?
So I would say that this year has remained a little bit more flat for longer than last year, where we started diving off into the new year because we didn't have any catalysts heading into the fall and winter. Now that we've had a steady flow of rate cuts, the market has kind of tread water instead of dropped off because people are realizing, some of my clients that I'm out there with, they're aware that rate cuts are coming and they know that you can't have cheap money and cheap houses. You get one or the other. So money's getting cheaper. We know what's likely to happen on the other side of that coin is prices are going to go higher. So they're out shopping right now, right? If you have the opportunity to do so, that would be my recommendation. Now, we don't rush out and buy something stupid or something they don't want. If you can't find what you want at the price range, that is what it is. There's not a lot of inventory right now to buy either. But I would be out there shopping and looking for what you want because seasonality is a factor right now as well. We are in the fall, winter season. Transactions fall off big time. Less people are shopping. They're busy with holidays, school, with their kids, etc. But come this spring coming up, that's when, like you said, you're going to have that rush. Everybody's going to be competing at the same time. It happened the last 3 years in a row, even in a down market. January, February, March, April, you've got 10 offers on properties.
Yeah, people are out there looking, right? I think one of the things that I try to remind my clients that are shopping right now as well is, in terms of fixed or variable, a lot of them are confused because they're like, if I go with the variable and if the rate cuts are coming, am I not going to benefit, right, from the variable?
Good point.
And so you could. So let's say your variable rate is around 5% right now, and if they cut another 1% over the next period, 12 months, for example, you're going to be at your net rate of around 4%. And that's what the fixed rates are at the moment. So you'd be paying a little bit of higher interest rate in the beginning, but possibly be paying the same or lower interest rate later on. And you can also convert your fixed rate, variable rate into a fixed rate. Generally, with most lenders, they'll allow you to do that without any penalty, right? So I advise the client that if you're looking to really just kind of maximize and you really focus and fixated on the rate that much, then maybe going with the variable as long as you get qualified at a little bit higher rate. Or if the lowest payment is the most important factor for you, then you have to go with the lowest rate, which is going to be the fixed rate, right? So those are pretty much like the two strategies. If you can qualify with the higher, you can do it. Otherwise, you can go with the lowest rate, which is usually the fixed rate right now.
Yeah, I agree. My most recent purchase myself was a 2-year fixed rate we locked in at because we were at peak rates. We had no choice. And the anticipation there was we're at peak rates are going to come down, but they're not there now. The spread between the fixed rate and the variable wasn't big enough, so it's looking like it's going to time out really well for us on that front because the rates have trended to where we are. So really good strategy there. If you can assume a variable mortgage temporarily, wait for rates to come down a little bit more, then lock it in at lower rates and absorb that higher payment for a bit.
For sure.
Probably the strategy that I would recommend.
And the other thing is, I would say is, generally a lot of times the clients are really locked in on the rate right now. It's a very rate sensitive environment, I find. But I think the most important factor in this transaction is the house you're buying, right? Because the rates, we've talked about this before, the rates are just temporary. So you're entering a contract for 2, 3, 4 years maximum generally, but the house and the price you're paying is forever. So, like instead of being so focused on the rate and what the rate's going to be and because the rate is, even if you're paying a little bit lower, like 0.10 or 0.20% lower, it's only a few $1,000s over that short period of time, where the price of the house is, once you pay it, you can't unpay it, right? So I always say, like, don't get too fixated on the rate. You can't necessarily control the interest rate environment right now, but you can focus on the home buying journey and the price and the property and enjoy that experience.
It's a great point. Like if you bought Berkshire Hathaway stock in 1970 for $2,500 a share, that's your cost basis forever, $2,500. Now it's trading at like $700,000. So that price that you lock in at is far more valuable than a temporary rate fluctuation, which it's going to go up, it's going to go down over 20 years of ownership. Nothing you can do about that, but that price will stay locked in. And we know that if you look at real estate or any other asset long term, the chart goes like this, up and to the right. In between, you've got periods of volatility, but it's always up and to the right. It's going to be worth more in 20 years than it is today because we're in an inflationary monetary system, and that's just the way it works, folks, unless that changes. So, yeah, really, really good points there. I would recommend that people focus on not what's happening now, but where we're heading. Try to get ahead of it if you can. Talk to your
Look at the bond market. Yeah, look at the bond market. That's a good indicator for fixed rates, right?
Yeah. Now, the bond market didn't move much. It went up a little bit, and then it went down a little bit on the announcement. If I understand correctly, typically the bond market will slightly follow the Bank of Canada yields. If the yields come down, bond market yields typically come, or the bond yields come down as well, but not in direct correlation.
Yeah, they're not directly correlated. There's obviously a lot of other factors. Bonds are, it's a type of investment that involves lending money at a certain cost. And so pretty much if the bond yields are higher, the interest rates will tend to follow. And so if you want to figure out, like, in terms of, why the fixed rates have not changed with the Bank of Canada rate announcements, you can always, Google some bond yields or returns on the 5-year and 3-year in Canada, and you'll kind of see how it's been trending. You can look at like a 3-month trend or a 6-month trend, and you can kind of see when was the best time to get a fixed rate. Right now, I'd say probably mid-September was a really good time to get some fixed rates. And it's gone up since then.
Yeah, for some reference, we peaked out at bond yields at around 4.5% in, looks like, late 2023, and now we're down to 2.995. So the bond yields are trending lower, right? And I would expect them to continue trending lower, but it's like a slow trickle, right? We go down to 0.5% in the Bank of Canada rate, you might see a 1/4 point of bond yields over the next few months as the market digests the data.
So the bond data is more of what's happening right now in the economy, right? So like the BOC makes the announcement, and then everything you see in the bond, it's kind of already priced in. So it's more live. So you'll see over the next few weeks, like if you look at the bond data, it's a lot more live data that's impacting that information. And so that's when, if you see the bond yields start going down, that's when you want to probably call up your lender and say, hey, I want to convert to my fixed. What's the best rate you can get me? Because now we have a little bit more spread to lend you the money on the fixed rate at a lower rate.
Very good point there as well.
Yeah. So, I don't know, man, I think that's a lot of information. What do you think?
Yeah, for sure. Very confusing sometimes with these rates and yields and affordability and the stress test. There's a lot of variables here. They've made it quite complicated. Of course, the government, that's what they do. So hopefully that helps people digest what happened, what didn't happen, why your affordability didn't necessarily go up, or your pre-approval amounts didn't go up yet. They probably will, but we still got a ways to go with rate cuts before you're actually getting approved for more than you would now.
Yeah. I think like the pre-approval amount, just to recap, they did not go up because unless you're getting pre-approved on a variable, it didn't change because the fixed rate has not changed.
And one thing I want to notate too, like aside from the approval amounts and whatnot, when we are in a rate cutting environment, it spurs economic activity as well. Yeah. All these businesses operate on debt. They're borrowing money. They're looking at the rates that they're borrowing money and see if it makes sense to take that borrowed money and invest it. And when the rates are too high, economic activity and business investment comes to a halt. Hiring comes to a halt. Wage growth slows because there's less demand for employment. Now that they're cutting rates, you're already getting investors starting to poke their head out, developers starting to poke their head out.
Absolutely.
Oh shoot, rates are down and they're coming down further. Let's get some shovels in the ground. Let's hire these electricians, these plumbers. So you're going to be having more people enter the market, more people making more money. hiring back up, employees, businesses investing in the future.
Overall, it's going to stimulate the economy. That's
Yes,
the
and
whole
when
idea.
the economy is stimulated and people are making money, what do? They take that money and they go enter the housing market for the first time, or they trade up.
Spend the money.
It's going to spur housing activity.
Yeah.
So economic data and rate cuts, like this is huge for the economy. The economy has been restricted. Nobody's doing anything for about a year. Like it was dead out there. Investors were crickets.
Yep.
Investors were buying up 25% of the housing. Building projects stopped. People stopped developing land. Why? Because the money is too expensive.
It's too expensive to borrow. Yeah.
So when this comes down, you're going to have all these people back in the labor market.
Absolutely.
Don't wait for the rush. Anticipate it. Anticipate what's going to happen. Now, we could be wrong.
FOMO is a thing. FOMO is a real thing.
Yeah, we don't know that this is exactly how it's going to play out.
Yeah.
But if I had to put money on it, this is how it's going to. This is what's going to happen.
Yeah.
Mostly because they really don't have a choice.
Remember we talked about this in one of the older episodes too, when we had said, they're probably going to make changes to amortization rules, and sure enough, like a year later, they made changes to amortization rules.
I didn't know what they were going to do, but extending the first-time buyers to 30 years and any new construction insured mortgages to 30 years, like that improves affordability by. I did some calculations, like around $50K for our local Windsor market. So, and also these people with credit lines and variable mortgages, $30 per 100K of savings off this half-point cut. That's on top of the other cuts. So now you're looking at some people saving $200, $300, $400 a month off their mortgage costs.
Mortgage payments, yeah.
Guess where that money goes? Back into the economy.
Yep.
So
big cuts, more big cuts to come. It's definitely going to be positive for sure.
Definitely, we're in an upward market and a downward lending market. So great hopping on the episode, Pritish. Appreciate the feedback. Very good information. Hopefully you guys got something out of this, and we'll see you on the next one.